My name is Troy Adkins, and I am the founder and owner of Adkins Capital Management, a firm dedicated to providing housing advisory services to households, investors, and communities across the country. As the third quarter of 2025 came to a close, the U.S. residential housing market found itself at a crossroads. Conversations across the industry kept circling back to two defining forces shaping the landscape. First, Adkins Capital Management completed a comprehensive analytical overview of the national housing market, an examination of price behavior, affordability pressures, and the shifting dynamics that continue to reshape how Americans buy and sell homes. Second, the Federal Reserve stepped into the spotlight once again. Its monetary policy actions, designed to support economic growth while navigating persistent inflation concerns and a cooling labor market, became a central part of the national dialogue. Every rate decision, every policy signal rippled through mortgage markets and household budgets. This presentation brings those storylines together. It walks viewers through the home price levels of select cities within the Adkins 60 City Home Price Index, highlighting where markets are stabilizing, where they're overheating, and where opportunities still exist. Most importantly, it equips prospective homebuyers with the information they need to make a prudent, well-grounded decision in a market that continues to evolve. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. ACM is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 20 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, more than 8 years of freelance financial and investment writing experience, and more than 5 years of state government experience at the agency and legislative levels. I am also the author of more than 25 published financial and investment articles. Accordingly, I am a 2023 inductee into Marquis Who's Who. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. During the third quarter of 2025, research conducted by Adkins Capital Management found that the residential housing market transitioned from a period of rapid appreciation toward a phase of stabilization and cooling. When we look at home prices today, we're seeing a market that's still rising, but clearly cooling from the breakneck pace of the past few years. Nationally, year-over-year price growth has slowed dramatically. What was once double-digit appreciation has eased to just 2.2% in the third quarter of 2025. That's less than half of the 5-year pre-pandemic average of 4.8%, and it signals a market shifting out of its overheated phase. Quarterly momentum tells the same story. Price growth has nearly stalled, coming in at just 0.2% from one quarter to the next. The engine is still running, but it's idling rather than accelerating. And the picture isn't uniform across the country. The Midwest and Northeast continue to post steady gains, supported by stronger affordability and more balanced supply. Meanwhile, Florida and parts of the West are seeing outright declines as the market recalibrates from earlier surges. Taken together, these trends point to a clear transition. After several years of rapid appreciation, the housing market is moving towards stabilization, still growing in many places, but at a pace that's far more sustainable than what we've seen since the early 2020s. When we step back and look at the housing landscape today, one theme becomes impossible to ignore. Affordability has become one of the defining challenges of this market cycle, and it's not driven by a single factor. It's the convergence of several pressures hitting households at the same time. First, prices themselves have surged. Home values today sit roughly 50% higher than they were in the early 2020s, creating a structural affordability barrier that didn't exist just a few years ago. At the same time, wages haven't kept pace. National income growth continues to trail, far behind the rapid escalation in housing costs, widening the gap between what people earn and what homes now command. Layer onto that the burden of today's mortgage rates. Elevated borrowing costs have kept monthly payments at historically high levels, even in markets where price growth has cooled. For many households, the payment, not the price, is the real obstacle. And then there's the pricing out effect. A significant share of buyers simply can't access the neighborhoods they once targeted. Their preferred areas have moved out of reach, forcing them to rethink location, timing, or whether to buy at all. The result is a market where, despite some recent moderation, the typical mortgage payment now consumes about 35% of the median household's income. That's well above the traditional 28% comfort zone, and far higher than the roughly 25% level we saw in the early 2020. In short, affordability isn't just strained, it's fundamentally reshaping buyer behavior, market access, and the geography of demand across the country. When we look across the country today, the housing market isn't moving in one direction. It's fragmenting. The same forces, rates, inventory, affordability, migration, are hitting regions in very different ways, and the result is a market defined by divergence rather than uniform trends. In the South and the West, we're seeing the clearest signs of cooling. These were some of the fastest growing markets during the pandemic, and now they're the ones experiencing more frequent price corrections as buyers pull back and inventory builds. Meanwhile, the Midwest and the Northeast are telling a very different story. These regions have held their ground. Prices are stable, in many cases still inching upward, supported by stronger affordability and steadier demand. Layered on top of this is the ongoing reshuffling of people. Post-pandemic migration patterns continue to reshape local markets, boosting demand in some metros while easing pressure in others. And that's before we even get to the hyper-local picture, where conditions can shift dramatically from one zip code to the next. Two neighborhoods separated by a single road can be living in two different housing markets. So when we talk about the housing market, we're really talking about dozens of micro markets moving at different speeds. Former boom towns are now correcting, while many of the affordable Midwest metros are proving remarkably resilient. The national story is no longer a single narrative. It's a patchwork, and understanding it requires zooming in, not out. When we look at the broader economic backdrop, it's clear that the labor market is beginning to exert real influence on housing demand. Employment growth is slowing across multiple sectors, and that shift is starting to ripple through buyer behavior. As economic uncertainty rises, confidence is taking a hit. Households that were ready to move earlier in the year are now pausing, waiting for clear signals about where the economy is headed. Many potential buyers are choosing to delay major decisions, including home purchases, until they feel more secure about their jobs and the overall outlook. That caution is shaping the tone as we move into the final quarter of the year. Market sentiment remains subdued, and buyers are approaching the market with far more hesitation than we saw even a few months ago. And it's not just one factor driving this. Some forces, like mortgage rates and employment stability, carry a high degree of certainty. They're directly reshaping affordability and buyer capacity. Others, such as the impact of the election cycle or shifts in consumer confidence, introduce meaningful uncertainty into the market. Together, these dynamics are creating a housing environment where caution, rather than urgency, is guiding buyer decisions. Now that we've broken down the market dynamics, the next step is translating all of this into practical strategies. And what we're seeing is that different players are responding in very different ways, each shaped by their own constraints, motivations, and opportunities. Let's start with first-time buyers. For them, the affordability ceiling is real. When 35% of household income is going toward a mortgage payment, every decision becomes more strategic. The savviest buyers are widening their geographic reach, looking beyond their first choice neighborhoods and considering townhomes or condos as entry points. The silver lining is that the fourth quarter should bring more inventory and potentially some relief on rates, which could open doors that were closed earlier in the year. Move-up buyers are facing a different challenge. Many are effectively locked in by the ultra-low rates they secured years ago. Giving up a 3% mortgage to take on a 6% or 7% one is a tough psychological and financial hurdle. As a result, we're seeing more creative approaches, contingent offers, bridge loans, and timing strategies designed to minimize the rate shock. And as economic uncertainty begins to clear, we expect more of these households to finally make the move they've been postponing. Sellers, meanwhile, are navigating a reality check. The biggest mistake in this environment is pricing a home as if it's still 2022. Buyers are far more price sensitive today, and realistic pricing is essential. For many sellers, spring 2026 may offer a more favorable backdrop, especially if rates ease and buyer confidence improves. Home builders are operating in yet another lane, with inventory levels nearly double what's considered balanced. Incentives aren't optional, they're mandatory. The builders who are winning right now are the ones leaning into affordability, focusing on attainable price points and locations that align with where demand is actually growing. And then there are real estate investors. The era of easy appreciation is behind us. Success now requires value-added strategies, disciplined underwriting, and careful market selection. Investors are paying close attention to the Midwest, where stability and affordability are drawing renewed interest. Across the board, the message is the same. The market is still moving, but it's rewarding strategy, flexibility, and realism more than ever before. With this overview of the ACM research in mind, let me now turn your attention to our analysis of the Federal Reserve's monetary policy. The general theme of this section is that the Federal Reserve opted to reduce the federal funds rate by 0.25% during the quarter, citing that maintaining elevated interest rates could risk driving the economy into a deeper slowdown or recession. As we move through the third quarter, the Federal Reserve signaled a meaningful shift in its outlook. For the first time in this cycle, the primary economic risk was no longer inflation. Instead, the Fed began pointing to emerging weaknesses in the labor market, warning that keeping interest rates elevated for too long could push the economy into a deeper slowdown or even a recession. Against that backdrop, the Federal Open Market Committee made a measured but important move. They cut the federal funds rate by a quarter point, bringing the target range down to 4 to 4.25%. It was a clear acknowledgement that the balance of risks had changed and that policy needed to adjust with it. And the housing market responded. At the start of the quarter, the average 30-year fixed mortgage rate sat at 6.65%. By the end of the quarter, it had eased to 6.43%, a modest decline, but enough to signal that monetary policy, economic sentiment, and market expectations were beginning to realign. To understand where we are today, it helps to zoom out. Mortgage rates have traveled an extraordinary path over the past few decades. The national average hit an all-time low, just 2.67% in December of 2020, and it reached its all-time high of 18.63% back in October of 1981. Between those extremes, the story of mortgage rates mirrors the story of the modern housing market. From 2000 to 2007, we lived in a pre-crisis era defined by higher, more traditional rate levels. From 2008 through 2019, rates trended steadily downward as the economy recovered from the global financial crisis. Then came the pandemic anomaly of 2020 and 2021, when rates fell below 3.5% and reshaped buyer behavior nationwide. In 2022 and 2023, we saw rapid normalization, with rates peaking near 7.8% as the Fed fought inflation. And now, in 2024 and 2025, we've entered a period of stabilization, hovering around 6.4%, almost perfectly aligned with the 25-year average of roughly 6.2%. Taken together, these shifts tell a clear story. The market is transitioning out of its volatile phase and into something more balanced. The Fed is recalibrating, mortgage rates are settling, and the housing market is beginning to find its footing after several years of extraordinary swings. With this overview of the Federal Reserve's monetary policy actions in mind, let me now explain the proprietary analytical methodology that was developed by Adkins Capital Management to analyze the home price level of the cities that constitute the Adkins 60 City Home Price Index. From a finance-based perspective, our proprietary valuation methodology analyzes the relationship between home price levels, household income levels, the percentage of pre-tax household income allocated to housing, and the cost of debt for a 30-year fixed-rate mortgage loan. From the first analytical perspective, our valuation methodology calculates the justified mortgage loan interest rate, which represents the cost of debt that justifies the home price level with the household income level, taking into account that 28% of household income will be allocated to servicing the mortgage loan. From the second analytical perspective, our valuation methodology calculates the justified percentage of household income amount, which represents the percentage of pre-tax household income that justifies the home price level with the household income level, taking into account the prevailing national average mortgage loan interest rate. Based on Adkins Capital Management's proprietary housing analytical methodology, this section of our presentation pertains to ACM's comprehensive housing analyses. The general theme of this section is that an overwhelming majority of cities, 56 out of 60, featured in the Adkins Home Price Index, are flagged for housing prices that exceed sustainable levels. When we examined the Adkins 60 City Home Price Index for the third quarter of 2025, one conclusion became unmistakable. 56 cities in the index were classified as overpriced when measured against the percentage of household income needed to justify current home values. And at the very top of that list sat the 5 most overpriced markets: New York City, San Francisco, Los Angeles, Newark, and Miami. These are the metros where the gap between what homes cost and what local incomes can support has stretched the furthest. To understand just how wide that gap has become, we ran a relative price level analysis. Even if you reduce the 30-year fixed rate mortgage rate from 6.43% all the way down to zero, the home prices in these 5 cities still wouldn't be justifiable based on local incomes. The disconnect is that large. And the picture doesn't improve when we flip the analysis around. To classify these markets as underpriced, buyers would have to devote between 75 and 83% of their household incomes to housing. Those levels aren't just unrealistic, they're fundamentally unsustainable. The takeaway is clear. In the nation's most expensive markets, the affordability challenge isn't a temporary condition driven by rates or short-term volatility. It's structural. Prices have moved so far beyond what local incomes can support that traditional affordability metrics simply break down. When we look at what it would take to truly justify today's home prices in the nation's most expensive markets, the numbers tell a striking story. For each city in the index, the median household income would need to rise dramatically into a range between roughly $131,900 and $392,400 just to support the median home price at traditional affordability levels. That's the scale of the gap we're dealing with. And when we reverse the analysis, the picture becomes even clearer. Using each city's actual median household income, the quarter-ending national average mortgage rate, and the long-standing guideline that no more than 28% of pre-tax income should go toward principal and interest, the justified home price levels for the 5 most overpriced cities fall within a range of $179,665 and $524,717. In other words, the prices buyers should be paying based on income are far below what the market is currently demanding. For households trying to navigate this environment, understanding the degree of overpricing isn't optional, it's essential. That's why prospective homebuyers should turn to the Adkins Residential Home Valuation Analyzer. It provides a clear, data-driven assessment of how local prices have drifted from what incomes can realistically support, helping buyers make informed decisions in a market where traditional signals no longer tell the full story. On the opposite end of the spectrum, our analysis identified only a handful of markets that remain genuinely underpriced. Out of all 60 cities in the Adkins 60 City Home Price Index, just 4 were classified as underpriced in the third quarter of 2025. Those cities, Detroit, Jackson, Fargo, and Des Moines, stand out as rare pockets where local incomes still align with or even exceed what current home prices would traditionally require. But understanding why these markets are underpriced requires looking at the mechanics behind the numbers. To classify homes in these 4 cities as overpriced, one of 2 things would have to happen. First, the national average mortgage rate, currently at 6.43%, would need to rise dramatically, surpassing each city's justified mortgage rate, which ranges from just 2.05% to 11.85%. In other words, rates would have to climb far beyond today's levels before these markets would lose their affordability advantage. The second possibility is behavioral rather than mathematical. Prospective buyers would have to decide that it's simply imprudent to spend the justified share of their income on housing in these cities, and given how far below national norms those percentages currently sit, that shift in sentiment is unlikely. Taken together, these dynamics paint a clear picture. While most major U.S. markets are struggling with structural affordability challenges, a small group of cities still offers meaningful value, places where incomes, prices, and mortgage rates remain in balance, and where buyers can enter the market without stretching beyond their means. Now that our quarterly residential housing market review is complete, here is some valuable information that you should consider. First, you can conduct similar housing analyses for your community and for your specific home purchase opportunities by subscribing to use the Adkins Residential Home Valuation Analyzer on Amazon.com. Simply search for residential real estate software to watch our 15-minute movie presentation and to subscribe to use our software. Second, there is a wealth of additional housing information on the Adkins Capital Management website, including our comprehensive home price index, interactive map of city housing analyses, news feed of pertinent housing information, housing methodology patent application, reverse mortgage loan analysis, movie catalog of quarterly residential housing market reviews, housing valuation methodology presentations, and tactical and strategic residential real estate hedge fund model portfolio. By visiting ACM, you can gain valuable insights into the housing market and make well-informed home purchase decisions. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.